welcome to my YouTube video on variances. I'm going to introduce a new approach to you. If you're fed up with trying to learn that should and did approach or using the formulas, then this technique is for you. I've been told it's a game changer, simply brilliant, a fun new way of understanding variances, finally. So let's start with the basics. The basics is all about flexing. Before you do variances, you have to flex the budget. The only variance which doesn't get flexed is the sales volume variance. So you cannot use the original budget for the sales price variances, the materials price variance, usage variance, and the labour variances. You have to flex the budget for the actual volume. That is so important. And that is why most of you will always get these variances wrong. So stop focusing on that original budget, always focus on the standards and use the flex budget to calculate your variances. So I'm going to introduce you Carla and her candles. Carla's candles are very on trend for the millennials who want urban themed candles at an inexpensive price. Until this year, Carla has been selling through local shops and trade fairs, receiving trade price for all her candles. But this year, due to COVID, she moved online. This has enabled her to sell direct to the public through her website, linked to her Instagram and Facebook accounts. Now, Carla's original budget is based on last year's sales and costs, operating over a 40-week year. So that's just setting the scene. This is the narrative that you're going to need for when you're explaining why the variances are what they are. So now let's have a look at Carla's candles results. So you're seeing at the moment her original cost card and an original budget. Now the original budget, as I said before, goes out the window unless you're doing the sales volume variance. But you do need the cost card. You need those standards. So if you look at the materials, you need to know it's 2 kilograms. Per unit at $1. And labour, you need to know it takes 15 minutes to make a candle at $12 an hour. And you need to know that the sales price was budgeted to be $15. So overall, we were budgeting a contribution of 10. Now these are our actual results. So notice she actually sold 2,500. She was budgeting to sell 2,000. So there's no point in comparing 2,500 with 2,000 because you're basically going to be getting a volume variance. Of course it was going to cost more to buy the materials and the labour because you've made and sold more. So what we do is we create a flex budget. And the flex budget works off the standard. So as you can see, the materials are now 5,000 if you budget to sell 2,500. And that's because it's 2,500 times the $2, which is the cost per unit that we budgeted for. The same for labour. That's now been flexed to 7,500 at $3 a unit for the 2,500. Now notice the only line showing under the original budget now is the contribution line, because that's our sales volume variance. And so that's how we calculate our sales volume variance. We move from the original budget to the flex budget by doing the difference between the quantity sold and the quantity that we originally budgeted to sell, times by the contribution of 10. And that gives us 5,000. We now no longer look at that original budget because we've calculated the sales volume variance, which takes care of it. The variances now are all calculated for the individual lines based on the flex budget. So the sales price variance is the difference between the 50,000 and the 37,500, which is the flex budgeted revenue. The materials variance, which is a combination of the price and usage variance, is now based on the flex budget. And so is the labour variance, which is a combination of the rate and efficiency variance. You're no longer using that original budget. It's out of bounds. Do not enter. So now we're going to look at splitting the materials and labour variances. So I've repeated them here for you. And again, I'm going to cross out that original budget. You no longer use it. To calculate the variances now, you need to use that standard cost. And you need to flex it for that 2,500. So I'm going to introduce more narrative now. Materials have been more difficult to get hold of, and she has sometimes had to buy in smaller quantities than she would like. Carla has sourced alternative materials from different suppliers to alleviate the problem. So using that narrative, when we calculate the price and the usage variances, we need to explain those results. Next, we're going to look at labour. She normally has 2 staff members producing the candles for her once a week, but this year one member has had to shield and was not able to work. Carla was able to furlough her under a government scheme. This has meant her other staff member has been working 2 longer days. So again, we have that narrative to help us explain that adverse variance for labour. But firstly, we're going to split it between rate and efficiency, and then we can really see what's going on. So we need to rebase by using the standards flex for the actuals. Always remember that. Okay, so now I'm going to introduce to you my diagram method. So first of all, we're going to start with the materials price variance. We've got to split that between the price and the usage. So what we do is a rectangle, and then we split it in 2 by creating 2 triangles. Because what you'll realise is you have to split the variance by using these 4 points: actual quantity, actual price, standard quantity, standard price. And the price variance will use 3 of those points, and the usage variance will use 3 of the points. But they'll both use 2 of the same points each. It's only 1 point that will change. So the blue triangle here becomes the price variance, and the white triangle becomes the usage variance. Now we're going to introduce the 4 points now. What are the values that we need on those 4 points? For the first one is the actual price. We need to calculate the actual price from the actual cost divided by the 5,500 kilograms that we actually used, and that would be 125 per kilogram. The standard price was given to us in the cost card, and that was $1 per kilogram. And then we've got the actual quantity. So the price variance becomes the difference between the 2 prices, and then we multiply that by the actual quantity. So we do the difference between the vertical and we multiply by the horizontal. So the result here is 1 minus 1.25 creates an adverse variance of 25 cents times by the 5,500 kilograms that we actually used, and therefore we get a 1,375 adverse variance. I'm now going to do the usage variance using 2 of the same points and 1 extra point, which is the standard quantity. So again, we need to fill them in. So we had the 5,500 kilograms from before, but now we have to calculate the standard quantity. You do not take the original budget, remember. You need to take the 2,500 units that were made and you times that by the 2 kilograms, which was the standard. We now get a rebase standard of 5,000 kilograms. Now remember, that is always going to be the case in your exam questions. You always need to rebase. And then we have the standard price as before. So now again, we're going to take away the difference between the vertical and times by the horizontal. So the difference between the vertical gives us the quantity and we multiply by the standard price. And therefore we get a 500 adverse variance. So that's my diagram technique for you. You're splitting the total material variance between price and usage, and you can see that you use 2 of the same points for the price variance and the usage variance. So setting it out like this makes sure you always will get this right. Because here we go, you can see that the price variance plus the usage variance adds up to the total variance. And the total variance will be the actual quantity, actual price, versus the standard quantity at the standard price. And remembering always, never forget please, that the standard quantity is flexed. So now we're going to move on to the labour variance and do the same thing. So now we're going to split between the rate and efficiency variance. And the four corners now become the actual hours and the actual rate, and the standard hours and the standard rate. We then get the rate and efficiency variances, rate variances in the blue triangle and the efficiency variance in the white triangle. We now allocate those four corners, so it's 750 hours with the actual hours, and they were paid at 13 an hour. And the standard rate is £12 per hour. So remember now, calculating the rate variance, you take the difference between the vertical and you times by the horizontal. And therefore we get 750 adverse. Did you have a go at that yourself? Well then, have a go at the next one. Have a look at the efficiency variance. Think about what figure are you going to put in those standard hours. Are you going to put the original budget figure, or are you going to flex it? Have a go. Well, let me help you. Remember, it takes 15 minutes to make a unit, so therefore it's going to be 2,500 times by 0.25 an hour, which is 625 hours. So that is not the original budgeted amount. Remember, we flexed it for the 2,500 that we actually made and sold. So again, have a go at calculating that efficiency variance. What are you going to do? You need to take the difference in the vertical and you need to apply the $12 per hour, the standard rate. And therefore you get an adverse variance of 1,500. Well done if you were able to do that on your own. So the efficiency and the rate variances add up to that total labour variance. And it's 2,250 adverse. So we're now able to do a causal track. This is a budget to actual. And what we do is we look at the original budgeted contribution and we track it to the actual contribution by allocating the variances to it. So first of all, we track between the original budgeted contribution and the flex budgeted contribution by the sales volume variance. And because we made and sold more at a contribution of $10, that is 5,000 favourable. And that meant our flex budgeted contribution is now 25,000 and not 20. Next, we have our sales price variance. That is favourable because we sold them at a higher price than budgeted. The material price and usage variances, though, were adverse. And so were the labour rate and efficiency variances. But because we have an increase in volume at a higher price, those have been offset. And therefore our actual contribution is 33,375. So those are the numbers, but we need to be able to talk about the reasons. So what's happening? Remember the narrative. The sales volume has increased due to online presence, expanding her customer base outside the local market. She was only selling to trade. She's now selling online. And the price variance is a result of that too. Carla has increased her price to $20 from $15 as she's no longer selling to the trade at 25% discount and is instead able to sell at full retail price direct to the end customer. And again, you can use my triangle technique to calculate that too. You take the difference in the vertical, the difference in the prices, and you times by the actual volume. Now let's look at what's happening to the materials. Remind yourself of the narrative. Materials have been more difficult to get hold of, and she's sometimes had to buy in smaller quantities than she would like. Carla has sourced alternative materials from different suppliers to alleviate the problem. So I have a poll for you. Have a go at this. Which two would be a correct statement to make based on that narrative and those variances. Carla has paid a high price for better quality materials. Carla has paid a high price due to buying in smaller quantities. The new supplier has charged Carla a lower price for inferior materials. And the current standard is outdated as it is based on 2019 costs pre-COVID. Which two of those would you say are correct statements? Pause the video perhaps and have a little think. So I'm going to give you the answers now. And the answers are B and D. She's paid a higher price because she's had to buy in smaller quantities. She's missed out on quantity discounts. And D, the current standard is outdated because it's based on 2019 costs pre-COVID. She's had to supply from different suppliers and probably had to pay higher prices for them. It's not A and it's not C. She's not got better quality materials. She's got an adverse usage variance. And the new supplier has not charged a lower price because we've got a high price variance. Hopefully you got those correct. So here's my narrative. The materials price has increased by 25 cents. Buying in lower quantities would mean higher delivery costs due to more deliveries in the year and perhaps missing out on quantity discounts. The alternative suppliers may also have charged a high price as Carla is a new buyer. Those are the things that you could infer from that narrative. I've taken it further. I've thought about it. I've linked it to the scenario. That's what you have to be able to do in the PM exam. You can't just say it's increased by 25 cents. You have to explain why and what the reasons could be. Again, material usage is adverse, and it could be due to wastage. The current standard is based on 2019 and might be overdated. Carla has used alternative suppliers with perhaps slightly different grade of materials, and these may be more difficult to work with or of lower quality. You can infer all of that from that narrative and looking at that usage variance in combination with the price variance. Let's now have a look at what you would think from labour. Okay, so we've also got two adverse variances here. And again, reminding yourself of the narrative, she normally has 2 staff members producing the candles for her once a week, but this year 1 member has had to shield and was not able to work. Carla was able to furlough her under the government scheme. This has meant the other staff member has been working 2 longer days. So again, which 2 would be correct? Carla is paid overtime as the staff member is working longer hours. Carla has paid a higher rate to the staff member for all hours worked. Production is far more efficient as the sales volume at 2,500 as opposed to 2,000 budgeted. And 2 staff members work more efficiently than 1. Again, pause the video, perhaps have a little think about that, pick your answers. I'm going to now go through them. So the 2 correct statements are A and D. Carla is paid overtime. She's working longer hours, so she's only paid overtime, higher rate on the overtime hours. So B is wrong. She hasn't paid a higher rate for all hours worked. That would be a significantly higher variance. And D, 2 staff members work more efficiently than 1, is also correct because there's only 1 member, they're not working efficiently because there's no production line anymore. So C is definitely wrong because they're not efficient. There's an adverse variance. So let's look at how I would write the answer to this. Let's now have a look at the narrative, what I would say to this answer. The labour rate has increased on average by $1. This will be due to overtime hours. It can't be due to them paying a higher rate over the whole time. As the team has been cut in half, the remaining staff member has been working a longer day to fulfil the increase in demand. So on that longer day hours, the extra hours, she's been paid overtime. Carla will pay an increased rate for that. Labour efficiency shows a significant adverse variance, as 2 production staff will work more efficiently than 1. Tasks were probably split between them, matching skills to different parts of the production process. Now that only one member is available, there will be a learning effect, as they need to get up to speed, and a loss of efficiency from no longer having an assembly line. So you can infer all of that from the narrative. You've got to stop just stating things and instead explaining, using the scenario to think why. Why is this happening? And therefore, you'll be getting those valuable marks. You can also look at there's a connection between the two, this interdependence of variances. So here the materials usage and labour efficiency variance are linked. New materials to work with from those new suppliers, slightly different grade, will increase the production time, and taking on a new process will increase material usage. So those are valuable marks to get to. Okay, finally we've got some conclusions. You always get marks for conclusions, 1 to 2 marks. So don't make it overly long, but make sure you do conclude and you don't lose those marks. Remember, 1 mark is 1.8 minutes, so you've got 3 minutes, well 3.6 in fact, to make a conclusion. So my first conclusion would be, in this pandemic year, Carla has seen significant change in her candles business due to COVID. She's been forced to move online, and this has resulted in extending her market reach. It's cut out the intermediary, allowing her to sell direct to the end user at the full retail price, saving her 25%. This has led to a significant increase in contribution of 17,500. So that's the volume and the price variance. But she's had her challenges. Through sourcing of supplies and a reduction in production efficiency, these have reduced her contribution by 4,125. But however, these are actually only temporary. So next year, she will have her trade customers back, supply will be back on track, and the staff member will return. Her challenge now will be to expand production to meet demand. So well done, Carla. She's got a good rosy year ahead of her. Well, that's it for my basic variances YouTube lecture. But as it says on the slide, you can apply this approach to advanced variances too. Now for that, you'll have to join my courses, and you can get in touch with me on my WhatsApp. Hope you enjoyed the new approach.